you heard from the Fed yesterday, and we read through the notes, and previously they had stated that they're not even talking about raising rates, and that's what they reiterated in those notes yesterday. So they're not going to be raising rates anytime soon. They're really telling you, though, they need to see the economy improve before they're going to continue or even consider tapering. So we have a long way to go in that regard.
So with that, if the Fed's not doing anything on the short end, the short-term interest rate side of things, yet the long-term interest rates continue to creep higher, does that then mean that we are in a scenario where the economy is forecasted to be better, that we will see growth ahead, that the yield curve steepening, so to speak, is going to be constructive overall for places like the banks and other places in the credit economy?
Yeah, that's our general take right now. We do still like the steepener. We think front-end rates are completely anchored. The Fed will not move through 2023. They reiterated that through their notes yesterday. But they're also still buying $120 billion of fixed income per month, and they're not going to be tapering off of that anytime soon. So with that, rates will be likely going higher, but limited in how much they can really go higher.
What exactly is playing out right now with regard to corporate credit? And one of the things that, Matt, that we brought up yesterday was this notion that we are seeing relative, and that's always a word in the markets, relative stability in the high yield side of the market, yet we're seeing a continued move lower in prices for corporate credit on the investment grade side of things. Mutual funds and investment grade ETFs continue to see outflows. What exactly is driving that besides the fact that we see interest rates moving higher on the Treasury side of things?
Yeah, so it's been almost exclusively because of interest rates. And so credit spreads are actually pretty much flat on the year. But what you're seeing overall is that you had a really tough quarter. You had about minus 4.5% for investment grade corporate credit for the first quarter of the year. That's the worst start we've ever had, and the second worst quarter in history. But with that, you've seen some stability the last week or so. We're seeing significant inflows from Asia on the institutional side. We're not seeing retail step back in yet, but on the institutional side, pension plan rebalancings, foreign inflows from Europe and Asia, those have really started to support the market.
Are there things in the credit market right now that scare you, that give you pause, give you a little bit of worry right now, given what we've seen with interest rates, given what we've seen with the equity markets right now? Does it feel like the markets are at least at a pause type moment?
Well, we're not scared about fundamentals. I think I have some fears about just the economy overheating this summer. I don't know that I definitely don't think it's a long-term thing, but this summer things are going to get really, really hot for the economy. And with that, you're going to see some inflation prints that are really going to pick up. And with that, you'll have some concerns that the market's going to have a few panic days for sure. But overall trends for corporate credit are really, really good. Corporations are paying down debt. You're starting to see investment grade companies borrow less money. They're going to borrow about 30% less money in 2021 versus 2020. So the fundamentals are in place for a really good corporate market, but the overall interest rate volatility is still here to remain.
Shepard Smith here. Thanks for watching CNBC on YouTube.